This is Voices and Visions,
Kenya is
truly the land of manifestations.
a podcast profiling Africa's business pulse through the people shaping it.
I don't think Kenya gets enough credit for how well it manages relationships.
Recorded in Nairobi, this season looks beyond headlines and funding rounds to understand how capital moves, how trust is built,
As much as I have a lot of respect for what Starbucks has done for the coffee community in the world, they wouldn't survive here.
and how companies scale in real conditions.
You are the owner of an electric mobility company that has no means of transportation of its own.
This podcast is produced by Tutupasa Agency. Welcome to the Silicon Savannah. Today, I'm actually joined by George Odo, who's a senior partner and a managing director for East Africa.
the firm's been doing this for 31 years. I've been with the firm for 17 years. Just about to start my 18th year with the firm.
He works at AfricInvest Capital Partners, a man with decades of experience.
You can't have an election across the border where somebody claims to have won by 98%. All of this becomes very untidy for investors. Investors do not like such uncertainty. Infrastructure is not there.
He has been investing across growth markets.
Emerging markets have become important. In fact, when you look at asset allocators globally, they see emerging markets as a separate asset class.
He currently leads deal-making and portfolio activity in East Africa and works closely with founders, family-owned businesses, and institutional investors.
The more we trade with each other, the more we manufacture locally, the more we add value locally, the more jobs we create. In Africa, we have the youth bubble, which can be a youth dividend if it's leveraged.
What does it mean to leverage?
That's exactly it.
Let's dive in. So, George, thank you for coming. I'm really glad you're here.
Welcome, nice to meet you.
Nice. So you're here with me because we're going to talk about the maturity of certain types of markets and the involvement of deal making. Would you describe yourself as a deal maker?
I guess so. I've been in deal making for some time, doing deals in private equity mainly, but working with colleagues who are involved in deal making in private credit and in venture capital.
When did you start? How did your career evolve?
Okay, so going back into time,
I'll just sit down for it.
I'll tell you,
time.
and then I'll try to do this efficiently. When I think back, today I work with a firm called AfricInvest. AfricInvest has been investing in the continent for 31 years now. I should be 32 years in May, the firm. And I'll tell you a bit about how it started. It started in Tunisia, and I'll come back to that. So the firm's been doing this for 31 years. I've been with the firm for 17 years, just about to start my 18th year with the firm. So
You're loyal.
I'm as old as the furniture in the company. And so I started off as a managing director for East Africa.
Yeah.
Today, I'm responsible not just for East Africa, but Eastern and Southern Africa, for operations in Eastern and Southern Africa. I'm also a senior partner in the firm and a member of our executive committee with a 9-person ExCo that runs the entire firm.
Okay.
And our firm is probably the largest in the continent in this business.
Yeah.
One of the oldest outside of South Africa. Largest because we have got over 110 people. We've got
Across the continent.
Across the continent.
Okay.
So 109 other George Odos straddling around the continent doing what I do, deal making.
Nice.
Yeah, there you go. And then we're present in 8 countries, so 8 offices in Africa.
Yeah.
Nairobi is now the second largest in the group, only second to Tunis.
Yeah.
That's where we started.
Is that why it's kind of a heritage?
That's a heritage. That's where we started off in 1994. And then we've got offices in Abidjan, managing our Francophone West Africa business, offices in Lagos for our Anglophone West Africa business, but still very strong presence in North Africa. So apart from Tunis, our other very important presence is in Morocco, Casablanca.
Okay.
And then in Algiers, Algeria, Cairo, Egypt, and latest office is actually Cairo. Before that was Mauritius. Okay. So very strong presence in Africa, and soon to open an office in South Africa. Probably going to be in Johannesburg either later this year or next year. Outside of the continent, we have an office in Dubai.
Okay.
Dubai, we actually don't even do private equity or private credit or venture capital. We do listed equities because we're trying to attract the Middle East investors, and they were more comfortable with publicly listed stocks.
Okay.
So that's where we started with them. But we've since seen the investors investing in publicly listed stocks in Middle East the Middle East region, and then North Africa, but then now coming into our other strategies.
Yeah.
And then we have an office in Paris.
Nice.
Paris offices, because we have a very strong partnership with the French government, we've raised 2 funds, about to raise a 3rd fund. But going back to the question you asked me, which is how long have you been doing this? So I've done it for 17 years with AfricInvest.
Yeah.
Before AfricInvest, I spent a good decade of my career with Care International.
Okay.
Care International is an NGO, one of the largest NGOs in the world. If you talk about top 3 NGOs, Care is going to be there. And Care is in over 70 countries. So I was in a development agency, an NGO called Care. What was I doing there? I was responsible for the microfinance investments and the little businesses with entrepreneurs in the SME and MSME sector, and doing this across several countries: Zimbabwe, Kenya, Tanzania, Uganda. So doing it across different countries.
But you decided to
And
switch.
I decided to switch, and this was an interesting one. So I was doing deal making, or pretending to do deal making,
for an NGO.
for an NGO.
Okay.
And why were we doing this? Because we realized that just handing out aid, doling out handouts is not sustainable.
Yeah.
You have to find a way to make development more sustainable. So we started to use development finance to invest in businesses.
Yeah.
So we invested in a horticulture company, for example, that was aggregating production, working with farmers to aggregate production and export to Europe. We're working with, that was out of Makweni in Eastern Province.
Yeah.
And later on in Nyanza, we worked, and Nyanza was, Makweni Eastern was for export. In Nyanza, which is in the western part of Kenya, was for the local market.
Yeah.
In northeastern Kenya, we were working with livestock farmers, trekking and trucking the livestock out of that fragile part of the country where there's a lot of drought, and sending it to areas where we can fatten the cattle and then sell them to big players like Farmer's Choice, Alpha Fine Foods. So these are the established players. What all of this does is we always started with the market and worked backwards. What does the market want? What structures do we need to put? Is it technical assistance to get the quality right? Is it finance to purchase the inputs? Do you purchase the inputs on bulk rather than purchasing small quantities? So we were using commercial methods to pull smallholder farmers out of poverty. And it worked. And so some of those institutions we set up, we sold them.
But isn't that, are you allowed to do that as an NGO?
Yes, you are. Because
Okay,
what
how
we
does
did,
that work?
what we did is, as an NGO, you can't do it for the purpose of making profit. What we're doing with the profits, we're plowing them back. So any profits we made, we plowed them back as a revolving fund to reinvest and help others. But that was a more sustainable model for development. Rather than going back to the donors every year to ask for more money, you're actually using the same money to recycle it back within the community. So did a lot of that, and people are not aware of this, but Care International started some private equity firms in Southeast Asia and in Latin America. There's a group specifically called SEAF, Small Enterprise Assistance Fund. So they started that. It's a very established group. They're working in Latin America, Southeast Asia, and they've recently come into Africa. Care International also started a microfinance investment group called Microvest. So again, using grant money, soft money, patient capital to start businesses which are sustainable.
Yeah.
A lot of microfinance institutions globally, including in Kenya, in Zambia, in Africa, but also in Bangladesh and other places, using the Muhammad Amin Grameen model, where you have group lending.
Yeah.
So it's again bringing people who are primarily assumed to be poor, low income, getting them to save and using their savings to
These micro savings groups?
It's micro savings groups and developing those into businesses.
Yeah.
Into microfinance institutions, which eventually go and take banking institution licenses. And some of the most successful banks, even in this market, like Equity Bank, Family Bank, those started in that model. So microfinance, building society models, and evolved into being banks today. Wow. So Care started a lot of those. Yeah. And so when I was with Care, I was doing that. Yeah. So when I left Care, I joined AfricInvest. The big difference was I was now not using soft capital, I was using commercial capital. Yeah. Now, what helped me was I had already a lot of experience in the region. I knew Rwanda well, I knew Tanzania well, I knew Uganda well, I knew Kenya well. What I didn't know very well was how to do private equity in its, strict sense. And that's what I was able to learn by working with AfricInvest.
What were the fundamental differences for you between
It's just being more disciplined, because when you have soft capital, there's a parachute, you don't make it, you get more soft capital. Commercial capital, there's no second chance. You've got to get it right the first time. So the failure rate is lower with commercial capital. It has to be.
Because
You have to be more rigorous in your deal selection. You have to be more rigorous in your success. You have to be more diligent to get a higher success rate. So that's what we did. So when you ask me how long I've been doing this,
in total,
at least almost 3 decades, 2.5 decades, huh?
I'm glad to sit with someone with so much experience.
Yeah,
I think that's a very good thing.
Yeah.
So one of the data points I found is emerging markets are now 30% of global PE and VC activity. In the early 2000s, so 25 years ago, that was only 5%. Why has it increased at such a large, fast rate, in your opinion? Where do you think it's going?
No, your data is spot on. Emerging markets have become important. In fact, when you look at asset allocators globally, they see emerging markets as a separate asset class. And, so you will invest in your traditional markets, whether it's stocks in the NASDAQ.
Stock, bonds, gold.
Exactly, the usual.
Yeah.
But then you'll see emerging markets as a separate asset class. It's a different risk profile, much riskier. They've got governance risks. They've got less developed infrastructure.
Yeah.
But what they have that the developed markets don't have is much bigger growth margins.
Yeah.
The growth is much higher because you're starting from a lower base.
Yeah.
So, and truth be told, even though you talk about 30% emerging markets, if you unpack it, if you peel the onion, you probably find that most of it is still Southeast Asia.
Okay.
It's India. It's, if you like, the more developed emerging markets.
Yeah.
If you were to do a deep dive, you'll find that Africa is still a very small proportion of that.
Yeah.
And again, we can talk about why Africa, why not Africa. Africa's had its challenges, and we've been watching capital flows, way back, because that's what we do for a living. And we have noticed that there's a time capital flows had sort of stopped coming to Africa, but we've noticed that they are coming back.
Yeah.
But not not aggressively, and not with the, in all these different markets. I think there's a recognition that Africa is not it's not a single market.
The homogeneity is not.
Exactly.
something
So you find capital going to South Africa, you find capital going to Egypt, you find capital coming to East Africa through Kenya, you find capital going to Nigeria. So it's very selectively.
Yeah.
And for good reasons, because the markets are different in terms of maturity,
Yeah.
the governance risks are different, etc.
Yeah.
But still, emerging markets are important. The risk is higher. So you have to go in with eyes wide open.
Tell me about the risks. So what kind of risks are we looking at?
So we're looking
Let's
at
maybe separate VC and PE.
Yeah,
So
yeah,
early stage
yeah.
companies versus growth stage companies.
Yeah. I think I will separate, but I'll talk about the common risks first.
Okay.
Then I'll come back to the separate risks. I think in terms of common risks, and this is something we don't like speaking too loudly about in the continent, but it's true, and I can speak about it, I'm Kenyan, I'm African, is we have a governance challenge. We have a governance problem, whether we like it or not. And governance is a big word. Again, if you break it down and ask, what does governance mean? It's as simple as you can't have an election across the border where somebody claims to have won by 98%. That's completely nonsensical.
Yeah.
You cannot have another election across the other side of the border where you kidnap your opponent, or you try to arrest your opponent after the election.
It makes for a great story, but I agree. Yeah.
You cannot have elections, or a situation across not too far away where two factions have been fighting for a few years, two generals, and forgetting that military is supposed to work for the people, not the people for military, and they're destroying the country.
Yeah.
And if you go to the Sahel region across West Africa, it's like, which is the latest coup?
Yeah.
Yeah.
It's hard to keep up with.
It's exactly. So we have a governance problem. But why are we getting all this unrest in the continent? Because we have the old man of Africa syndrome. You have
What is
people
that?
What it is, Ivana, is we have presidents, the oldest presidents are in Africa. They're in their 80s, some are even in their 90s.
So they're almost as old as you are.
How I wish. If they were the age
17
group,
years at African
there you go. If they
No
were that
worries, it
old,
doesn't show.
yeah. So let me tell you, the problem, actually, it's a real problem because you find that they're not handing over power to the next generation. And so when I think about generations in power, I can think about, generations which have been missed. There are very many.
Yeah.
And so you find that that's a real problem. And then it comes with corruption because people get into corruption to preserve their power. And that's a real issue. Now, all of this becomes very untidy for investors. Investors do not like such uncertainty and such, instability.
Yeah.
So that's risk number one, governance, without doubt. And then risk number two, again, across whether it's PE or VC, is infrastructure. Infrastructure is not there. Today, I think Africa probably accounts for 2% of data centers in the world.
Yeah, there's a big investment to be made.
There's big investment to be made.
Yeah.
If you look at other infrastructure, whether it's in the energy sector, whether it's in the telco sector, whether it's roads, it's a problem. We don't have enough investments going into those areas. So those form a problem. So it's also not fair when you compare an investment in a country in Africa with an investment in a country in Europe or in Asia, in a more developed part of Asia, or in the US. Yeah. It's not like for like. So we have a governance issue, we have an infrastructure issue, but we also don't trade enough with each other. We don't trade enough with each other as a continent. In fact, I remember the first time I started getting engaged in a conversation about intra-Africa trading with each other. Yeah. The number then was probably 12%.
It's very low.
It's very low.
Such a massive continent.
Exactly. Now, if you compare to other continents, they're all over 50%. What does that mean? It means that if you and I are neighbors, we're not trading with each other, we'll go and trade with everybody else around. What does that mean? Our cost of trade will be higher because of transport. There's going to be foreign currency risks. There's going to be all sorts of risks. It's easier for us to trade with each other. But the continent is learning.
Why did they stop doing? Why did they not do that? Because trading with each other is the oldest type of trade, right?
Absolutely, spot on. I think we got carried away. When I was a younger guy, when I first started working, the focus was on export. So, Kenya, for example, got their export product, got their fruits, flowers, vegetables, they exported. That was the big thing. Everything was export, and we exported a lot of raw materials. Yeah. Today, the mindset has changed. Even Nigeria, you export crude. That doesn't make sense. You need to be processing it in your home country, because otherwise somebody else is making the money.
And someone else is getting the job.
Exactly.
To do it.
So if you're actually adding value in your home country, first of all, you preserve capital, you're creating jobs, you're creating value and preserving value. It makes more sense. And so then you start to trade locally. So if you have a finished coffee product, a finished tea product, you can sell it to your neighbors. Yeah. But the raw material, sending it to them doesn't make sense. They can't process it. Yeah. So there's a mind shift happening and people are thinking differently. So the shift has changed from export to trading locally. And you can see it in the numbers. If you look at, again, I'm going to give the example of Kenya. Kenya's biggest trading partner for the longest time was the UK. For the longest time. And
I thought the Netherlands.
No.
I was actually almost proud of that.
No. Ivana, it was the UK. And it comes from the colonial connections. Yeah. Then it shifted from the UK. It probably went to China at some point, because actually before China, it was India. Then it went to China because we were importing a lot of stuff from China because they're cheaper and bring them here. At some point, a couple of years ago, it was the US, because the US invested heavily in this economy in terms of US multinationals, in terms of VC funding. Yeah. There's a lot of for foreign direct investments, FDIs flowing into the country. But what was interesting is the fact that Uganda is in the top 5, and now Uganda and Tanzania in the top 5. What does that tell you? That the region is beginning to trade more with each other. Yeah. And we've created as a continent several regional trading blocks. There's the East Africa community, there's the COMESA, Common Markets Trading, there is the ECOWAS in West Africa, the SADC in South Africa. The most successful one is actually the East Africa one. Yeah. That's where, if you start looking at the trading numbers, that's where you get the best data in terms of uptick. Yeah. And the trading, intra-Africa trade in the last few years has actually shifted from 12% The last numbers I've seen are between 14 and 16%. That's positive. It's trending in the right direction.
Yeah.
Now, with the Africa Continental Free Trade Agreement, which was a concept that was set up recently.
What is that? Can you explain how it works?
Yeah, so Africa Continental Free Trade Agreement is an attempt to get the whole continent to be one trading bloc, so equivalent of the European Union.
Okay. And then specifically directed at commercial...
It's directed at Africa. And that's important because it goes back to the question about risks. The more we trade with each other, the more we manufacture locally, the more we add value locally, the more jobs we create.
The more sovereign you are.
Exactly. The less dependent you are on foreign aid, etc. So the Africa Continental Free Trade Agreement was a recognition that, look, we're not going to be one Africa Union today, which was the whole premise of Africa Union. We want to be like the EU. We're going to be the AU. It's not going to happen. We're 54 countries. Everyone wants to be a king or a president.
It's pretty difficult,
Yeah, but then maybe we can start by trading with each other.
Yeah.
If we see the benefits of trade. So that was the purpose of the Africa Continental Free Trade Agreement.
Yeah.
Get that right, the rest can follow. And maybe regionally, you might find there's more willingness to have political agreements later, one currency later, but let's start from by trading with each other. So that's what the ACTFT is, Africa Continental Free Trade Agreement is about.
Nice.
That said, going back to your question on risks, we've talked a little bit about risks which bedevil the whole continent. There's one big risk we must talk about, which is the youth bubble.
Tell me more.
So today, 75% of the continent are youth.
Which is great. If you look at Europe, we're all getting too old.
Exactly.
So there's actually...
Exactly.
I look at it as positive.
So it's positive if you use it properly, if you exploit it. And exploit it in a good way.
Don't exploit children.
No. Not in a bad way. Maybe exploiting is the wrong choice of words. If you leverage it.
That's a good word.
If you leverage it. Because your youth are your strength. Because that's your future. And those are the guys who are tech savvy. Those are the guys who don't have any issues around, the old ethnic and regional hang-ups. That's where the future is. Yeah. And as you've said rightly, Europe, Asia, even China. China had a one-child policy. Now they're struggling. Now they actually flipped it around and they ask people to have more babies because the next generation is at risk. Mm-hmm. So in Africa, we have the youth bubble, which can be a youth dividend if it's leveraged.
What does it need to leverage that?
Now, that's exactly it. We need to fix those other issues. We need to sort out the governance, stop the corruption. We need to have proper governance, proper infrastructure in place. We need to invest in infrastructure. We need to have, and infrastructure includes technology, it includes power, it includes roads, all of that needs to be in place. We need to encourage more home manufacturing, value addition, so we can trade more locally. All of those need to be done because as you're doing all of that, you're actually creating jobs. Yeah. And creating jobs, by the way, we need to debunk this. Jobs does not mean going to sit in an office, in a white-collar job. That's not what a job is. Job is just a means of income. Yeah. We should encourage people to set up businesses and have a means of income, which is why the Silicon Savannah is very relevant. Yeah. Because the Silicon Savannah recognizes that jobs are going to be informal, and informal jobs are not a bad thing. Informal jobs are actually the employers of the future. Yeah,
people can have a portfolio career, doing multiple jobs at the same time.
Exactly. You can employ others. You can create jobs for others. Yeah. That's what it's all about, investing and leveraging on technology. Yeah. So those are the sort of things it'll take. Now, going back to your initial question, VC versus PE challenges we are seeing. The thing with venture capital businesses is one, the failure rate is higher in Africa than you'll find in other places because of all the problems we've talked about. If you don't have the infrastructure, etc. So that's always going to be higher. So it's tougher to get a unicorn in Africa than it is in other places. Mm-hmm. But, and we'll come to the buts later. So that's one issue is a success rate. It's a tougher environment. Another challenge you'll find is there's a shortage of products. So, and let me be specific.
Of end products, you mean? Like we talked about the manufacturing? Or
no. Different type of products, financial products. Oh. So you will find, if you're a young lady, young man looking for seed capital, it's going to be difficult to find it. there are not enough high net worth investors, not enough angel investors willing to back local. And it's going to be the industry, and we'll come back. I think it's a big topic. Should we depend on local capital? Should we depend on foreign capital? Today, we are very heavily dependent on foreign capital, even for startups and venture capital. And truth be told, even a lot of the businesses that look like are succeeding are backed by young foreign entrepreneurs rather than local entrepreneurs.
But in an ideal situation, it would be a flywheel, right?
Exactly.
If there's not enough local capital first, get the capital in,
and then,
start the M&A process.
Yes.
Consolidate.
So there is a shortage of financial products.
Okay.
And if you think about it, if I was a foreigner, I was asked to go and invest in a market I was not familiar with. He told me, George, go and invest in Syria or go and invest in Lebanon. I don't know the market well. I've just read some horror stories, so I'd be very careful who I back. And I'd be very cautious how much. Almost a drip feed model.
Yeah.
I'd back.
You'd put in different terms.
Different terms, exactly. So it's tougher.
Yeah.
And so seed capital is lacking. First of all, investors are lacking. And if you get investors, you're not going to get seed funding is more difficult. So seed funding has to be done by yourself as an entrepreneur. In fact, I have a friend who says that the seed round is for,
friends, family, and
fools.
Fools.
Exactly.
Do we have enough fools here,
Exactly.
Yeah.
So it's difficult to get the seed capital in. Now, even if you get the seed capital, then you have to go to the next round, which is probably, so maybe you raise pre-seed money, then you'll raise the seed round, then you'll raise the Series A.
Or the pre-Series A.
There you go. Exactly. Now, in private equity, you don't have all those steps. No. And this is something that you find in this industry, venture capital, and yet there aren't enough products. One of the things we're doing as AfricInvest, I've got a colleague, he's going to be in Nairobi this week for the big tech conference. He's working with a Canadian group called MEDA and MasterCard to develop a product for the venture capital space as a follow-on for secondary investments.
Okay.
So there's a shortage of secondary investment.
Follow-on capital.
Exactly. So he's developing a product for that. There'll be a fund that will specialize in that. It'll allow the fund to also take away some secondary capital, so buy some shares, but put in primary capital as well. So that's important. So shortage of products is one problem another problem that the VC space faces.
But that's, I think, a very good thing, right? Because follow-on capital is something that is especially relevant for infrastructure and innovation and industrial technology, where you just need to stay involved a lot longer.
Absolutely.
So building this would have a positive effect.
It makes a lot of sense. I mean, another good example of how investors are becoming more innovative is I like to speak about MasterCard Foundation. Yeah. The MasterCard Foundation, for me, they get it. They're one of the new investors in town, but they completely get it. They're coming with relevant products. They've got a fund that invests into businesses that are set up by women entrepreneurs. Yeah. And for me, that's really exciting. So what they've done is they've created a fund of funds. They're investing into private equity groups like ourselves that are led by women. That's point number one. That's test number one. Are they led by women? If they're led by women, that's great. So can they invest in women businesses? So what you're seeing is a group that was previously put aside, didn't have access to capital, suddenly has access to capital. And we know that access to capital is one of the biggest issues, especially in contexts such as ours in Africa, where the title deed of land is kept by the man. Most of the properties are held by the man. And traditionally, women get married and are seen to leave, and all the property stays with the men. So there was a very obvious case that women lacked capital. So they're addressing that directly. But from a bigger perspective, they're addressing job creation amongst the youth. That's a big agenda for them. And so they've got a lot of capital that's been allocated to them, which is really targeting job creation in the continent. In fact, if I remember my numbers well, they want to create 30 million jobs in the next 5 years. And they're not just jobs, they're quality jobs and sustainable jobs. Yeah. That's what they want to do. So investors who are thinking like that and not just thinking about coming to make money are the right type of investors for the continent. So to an extent, although impact investing has become a bad word, it's very relevant.
impact if it means sustainably
if it
developing
means
a business.
exactly, it's got to be sustainable,
Yeah.
about sustainability.
Yeah, on the people side, I think is the most important part right now.
Exactly,
Yeah.
exactly. So so to just pivoting on. So those are some of the challenges you find with VC.
Can I ask one more question about VC
Absolutely,
before we go on?
absolutely.
So VC, we often talk about this Africa risk, and then it's included into the term sheet for the founder.
Yeah.
So that means that at a very early stage, there's either a lot of dilution going on, or worse terms, or to a certain degree an expectation that the business should run at the same speed as it might do in Europe, according to the European investor, or to the US. What kind of terms have you seen, and what would you recommend to any foreign investor coming in or seed?
Yeah, you're asking all the right questions, Ivana.
I know, thank you. I'm very, very well prepared.
Unfortunately, people come with term sheets and terms which work in other markets, and they want to copy and paste. Yeah, it doesn't work like that. You've always got to think about the context. You've got to remember you work in an environment that isn't as developed, infrastructure is not as developed.
Yeah.
Entrepreneurs are probably not as sophisticated.
Yeah.
In fact, half the time we spend we never do a deal quickly. We spend a lot of time training and in educating our partners. If we intend to have a long-term relationship,
of course,
you can't be seen to be taking advantage of them. So you've got to do that. But a lot of times people come with terms which are not necessarily relevant in this market. And so one has to, we have to think differently. We have to think differently. And it's, over the weekend, I met an entrepreneur who's coming in with this really cool energy tech business. And what I said to him, he said to me that a certain investor wants to give him $1 million.
Yeah.
He's doing his seed round. So I said to him, that's great. It's good that the investor's showing confidence in your business and other people. But I would encourage you not to take it as equity.
But debt funding?
Yes, because you'll get diluted. And you wish, because
you're too early to get funding.
Exactly. Yeah. So, there is a structure, safe note.
Yeah.
Or, some sort of a convertible bond, can convert it later, but avoid taking an equity. And this was very strange advice coming from somebody who invests in equity.
Yeah. But that's funny because it came out in the report as well, the Africa report and the Partech report, that there has been more debt funding flowing into the continent as opposed to equity funding for the first time.
That's good. I think that's positive. And it's relevant, and again, reminds me of why we went into private credit.
Yeah.
Because we realized that not everybody needs private equity. Sometimes a debt is the right solution, but it's got to be at the right terms.
Yeah.
It's got to be patient. It's got to be tied to cash flows.
Yeah.
So it can't be that I give you debt, then I come and start auctioning your business or taking over your business. It's got to be tied to the cash flows of the business. And it's got to take into account that the cash flows may not come as we all envisage.
Yeah.
And the structure has to work in a way that you keep the founder or the sponsor motivated. So you cannot dilute them. The more you dilute them, the less skin they have in the game, you're losing that very important stakeholder.
Yeah.
So you've got to have a structure that works also for the founder.
Yeah.
And keep them motivated. So investors who rush at diluting founders, the investors who rush at taking over businesses they cannot run from offshore, are the ones who often find themselves shutting down their startups. The ones who are smarter and think about how to keep the sponsors engaged, it works out. But you asked a question about Africa risk. So one thing that's very important also is whoever comes into Africa to invest, you must also be thinking on how do you, build the capacity of the founders.
Yeah.
So it's not a matter of the problem is sometimes not just writing a check. It's bigger than that.
It's team structure, behavior.
It's team structure. It's building a bench around, because the founder is going to take it this far. To the next level, they need other skills.
Yeah.
You've got to bring those skills. How do you motivate those skills? It's your board. It's your governance structure, even at that micro level. Forget country governance or macro issues. At that level, you've got to have your governance right. Yeah. So you cannot be making decisions over the dinner table as much as you want to be nimble and everything. You've got to start to grow into a formal structure. How you bring in independent directors who can speak truth to power and tell you, Ivana, you're buggering up. You need to fix this. Yeah. So you've got to have a proper governance structure. Yeah. You've got to have proper books of accounts. You've got to separate your personal from the business. So those are also part of growth. You've got to take a broader perspective of business growth, market entry.
And
exactly.
Yeah.
It moves more from an entrepreneur naturally responds to market. They've got an instinct. This is a good business. I'm going to do it. It's going to move from that to a market research-driven decision when you start to get more mature. So how do you do all of this as an investor? So what we found works is you come in not just with your investment capital, you've got to come with some soft capital. So going back to my care days, where you have grants, which are smart subsidies. That's what we call them. So you're not just subsidizing a company, they're smart subsidies. They're there for a short term, a short time.
An acceleration.
Exactly. And you're not asking the company to invest in that. As the company gets more mature, you can actually ask them to contribute towards that. Yeah. So it can be a 50-50 model. Initially, you probably want to invest in that because you're investing in the business with soft capital grants. And so a lot of the development financial institutions, IFC, Proparco, and others, they actually have a component of technical assistance grants along with commercial capital. The commercial
specific
capital,
questions.
Exactly. Whether it's strengthening management, strengthening boards, etc. And in environments like Africa, where it's tougher to make businesses work, you have to think like that.
Yeah. And do you think, because we talked about that the most important part is the youth, right? And then youth goes to school and university. Is that a place where people should be sourcing the founders of tomorrow? Do African and Kenyan universities give enough entrepreneurial skill development and training?
So I'll tell you two stories, very quick ones. One is when we as AfricInvest first came into the market, we came into the market in Kenya. We came in 2009. One of the things we did early in the days is we got into partnerships with a group called YPO. It's a youth, young. What's the
Young people organization?
No.
Trying to find out the acronym.
It's young entrepreneurs. I forget what the acronym stands for. But then what it is, it's young business people who are literally in the startup business, early stage business professionals. And, so we go into partnerships with them. And one of the things we said is, can we identify in Kenyan universities people with good business ideas? So we went out to universities, Jomo Kenyatta, Strathmore, Nairobi, and others, and identified students with good business ideas. But one of the criteria to be in that competition, so it was a business plan competition, but for students. And one of the criteria is you had to still be in school. You cannot drop out of school. You've got to be studying.
Okay.
And so you've got to show that you still value education, but you're studying. And what happened is we sponsored that for a few years, then we stopped. But that was a good idea because, again, we're not backing entrepreneurs, we're backing ideas and encouraging the youth in universities to think about that. So that's story number one. So there is a case for going out to universities to look for businesses, look for business ideas, look for entrepreneurs of the future. Then there's story number two. When you think about it, entrepreneurs, I mean, the George Odos and the older guys are going to fizzle out at some point. Where the next generation of entrepreneurs is going to come from? You've got to start building them. You've got to start finding them. So you've got to get corporates investing in this space.
What do you mean?
So I'll tell you. So a company like Britam, it's the largest underwriter in the region, insurance company. They invest in, basically the everyday businesses, life insurance, property and casualty, so medical, all sorts of insurance. And they're in 7 countries, 5-6 million clients. The biggest by far in the country, 25% market share in life, over 40% market share in microinsurance. They're basically the biggest gorilla today, and they've done very well. But then they also realize that they've got to invest in the future. So what they're doing is they've started a beta lab. And so it's an incubator, accelerator, where they get young entrepreneurs coming with ideas and they fund them. They give them a little bit of funding, but more importantly, give them a training and help them to fundraise if it's a successful business. But what are they doing? They're investing in the business of the future. What are they also doing is if they see good business, exactly, you've got it. If they see good business ideas, they invest in it because that's what's going to be the future. Today's business models are very different from what was there, a few decades ago. So they're thinking like that, investing in the youth. And that's important.
And if we look at corporate venture building, or
corporate venture capital.
these labs, right, especially now, they must have they must require access to data sources and potentially, you know, data centers or good computing power. Is that something that is actively being worked on as well, to be able to build bigger research labs for technical investments in this country?
It is one of the areas that has been identified as a good investment area.
Yeah.
And believe it or not even so much by VC, but by the PE guys.
Okay.
Because they see the gap.
Yeah.
And remember, PE is the big brother.
PE has more capital allocated.
They've got more capital
Yeah.
allocated. But that's, if you're going to build data centers, it's going to take a lot of capital.
Yeah.
So the PE guys are investing in that space. But interestingly enough, you're finding PE investing in tech businesses that they would not have done before. They're getting out of their comfort zones. We've done that.
Yeah.
We invested in a business called Mkopa. Mkopa started off 15 years ago as a solar tech business, energy business. 5 years ago, they pivoted to financing smartphones.
Okay.
Big
Pivot though.
Big
From
pivot,
solar
completely
to-
big pivot. But you know what? That tells you something. Only an entrepreneur will do that.
Yeah, that's true.
I don't expect some of the more traditional businesses to do that. They don't have the ability. It's like a big ship.
Yeah,
It takes a
you
long
can't
time to
just turn
turn.
it.
Exactly.
Yeah.
So the beauty with businesses like that is they realize something's not working. You've been doing it for a decade.
Yeah.
Quickly switch. So they switched to financing smartphones. And last year, for the second year in a row, they were the largest smartphone financer. They financed more smartphones and sold more smartphones than Safaricom.
There we go.
That tells you something.
Safaricom is coming on the podcast, so
Exactly.
I'll tell them.
Tell them that.
Tell them they
that.
need to
Tell
work
them
on the
that.
numbers.
And you know, so these guys have 7 million clients in Kenya,
Insane.
Uganda, Ghana, Nigeria, South Africa.
Yeah, it's a good investment.
This
you
company could easily be the next, probably not the next, could be the first Kenyan unicorn.
make. Yeah.
They're backed by groups like Sumitomo. Japanese are very conservative. 20% of that company is owned by Sumitomo.
Yeah. Well, then let's talk about the next step that's going to happen.
Yeah.
How about IPOs in capital markets?
That's very,
unicorns?
very important. So yes, we've talked about investing in tech companies because these businesses did not exist before.
Yeah.
So we traditionally invest in banks, insurance companies, schools,
The safe
manufacturing
schools.
companies.
Yeah.
Those are the traditional businesses.
Yeah.
But then there's the tech companies that are coming up, insurtechs, fintechs.
Yeah.
There's a company called Turaco that's doing a pay-as-you-go insurance on the phone. So
That would be amazing.
We've invested in that.
Yeah.
And so we've invested in
Can
Mkopa
they
that's
come
doing
to
phone
Europe?
financing. They will.
We've overregulated a few spaces.
There you go. So, but then going back to your question, we did the traditional businesses, then we've done these tech
Yeah.
businesses. That must be the role of investors like us.
Yeah.
But to democratize this space, we have to take these businesses to market.
Yeah.
We have to bring businesses to capital markets. We have to move away from the capital markets being seen as an elitist space where only the high and mighty and the rich and the middle class can participate. Everybody needs to be able, the same way you save a little money, whether it's on your phone, you should be able to go and participate in the public markets. So I think it's imperative, it's important for private equity folks like us to walk the talk and take some of our businesses to market.
But that must be incredibly difficult in a weak capital market.
It
with a
is,
lot
but,
of-
but you know what, Ivana, we're seeing improvement. I look back to 2024 December. We listed a company in Casablanca Stock Exchange, oversubscribed tens of times. So it's 30 times oversubscribed.
Yeah.
The price we got when we listed it and the price a year later, last year, December, was almost double.
Nice.
And so one of the disadvantages with that market is you sell. If you're seen to be an important investor, you have to hold your stock for 3 years. So we sold half, we held the other half for 3 years. So those are the sort of regulatory changes that we need to address if we are to get more listings, because very often we have limited life funds.
Yeah.
So we can't afford to lock our capital for too long. But taking companies to market is important. We are today working with the Nairobi Securities Exchange and Capital Markets Authority to try and see if we can take more companies to market through the industry association locally in Kenya.
Yeah.
South Africa is an important market because no matter what you say about South Africa, it's still the deepest market. That's where the deepest capital markets are. And that's where we've seen some listings happening and more are going to happen.
Is that why you open in South Africa?
That's one of the reasons, because it's the deepest market. It's because we're seeing South African investors interested in investing in our funds. It's because we're seeing South African companies that want to come up north and they're struggling with how to do that. And we think we can help because we've invested in more than 30 African countries. We've done more than 200 transactions in the continent and 140 exits. So we think we can add value. So that's one of the reasons we're going.
Yeah.
But going to your question about capital markets, I think it's very important. We invest already in capital markets. We can invest in a company that's listed.
Yeah.
So our investment in I&M Bank, it's a regional bank listed in Nairobi Securities Exchange. Our investment in Britam, it's a listed insurance company listed in Nairobi Securities Exchange. We can invest in listed companies and help them to grow, help them to become bigger, better, stronger regional champions. But it also makes sense for us to bring more companies to the market. Yeah. Because gone are the days when you put your money in the bank and hope to get a return. That's not going to happen. From a savings,
those days are over.
Yeah, those days are over. Today, what's sort of coming back and exciting, I think, not just the market, but the youth, is the ability to invest in money markets, asset management products, investment products through your phone. I think being able to invest in the stock exchange, to participate in companies, we can buy and sell.
Is there access?
There is access,
via
but
phone apps?
there is, and that needs to, we need to get more companies. You can't have 50, 60, 70, less than 100 companies in the stock exchange. You need to have a lot more. Yeah. You need to have deeper markets. People need to be able to trade. Liquidity needs to go up. I need to be able to buy today and sell 3-4 months if I need the liquidity, or buy today and keep for a few years if it's a dividend play, depending on the profile and the objective and the motivation for investing. But capital markets are important because remember also, Ivana, capital markets will then provide the capital that's required for the local companies. Yeah. So we're not always dependent on foreign capital flows to come in and fund our businesses. Yeah. And that's a big change I'm seeing. If you ask me, what have you seen differently today and a decade ago? Today we are seeing pension funds investing in private equity. We're seeing pension funds investing in infrastructure. Yeah. We're seeing
local pension funds.
Local pension funds, Ivana. So that's a big deal. It's a big deal. It's taken a long time, and they're coming with as small investors, but we can see that growing, and that's very positive because that wasn't the case a decade ago. I mean, it's ironical to see foreign capital coming and investing into private equity, which then buys Java, which is one of the famous coffee houses, or Art Cafe, or buys Equity Bank. Yeah. And then when you again look behind the curtain,
all the money's going out.
Exactly. It's a foreign investment. So you may think it's a Kenyan brand, but it's foreign owned. So there's no reason why we can't own those assets locally. Same thing applies whether you're in Zambia, in Tanzania, Uganda. Yeah. So we're going to see local capital flows, and that's a positive thing. And again, you don't need to always repatriate your money out. You're keeping the money in the local economy. Yeah.
But one thing you need to be able to keep money in the local economy is access also to money, to digital money. So that brings us, of course, to a concept of bankability, access to, well, whether that's payments infrastructure or, like you said, other types of financial products. One of the things I wanted to ask you is we've seen that there's more debt funding flowing in. Yeah. If you see more debt funding likes good cash flow. Yeah. Right. Yeah. Equity funding likes part of it. Debt funding wants a good cash flow. Yeah. Can we say that Kenyan businesses are higher in cash flow in general, if you would look at their statement, because they run a business that is both with a bank as well as through the use, for example, mobile money, which is something we don't have in Europe, right? So European businesses might look like they have a way stronger P&L, but the cash flow of an African business might be a lot higher, or Kenyan business might be a lot higher.
Actually, invariably, SMEs and MSMEs, so micro and small enterprises, the micro and the small will have much higher cash flows. Yeah. Because what tends to happen is if I'm selling secondhand clothes, running a micro business, I'll buy clothes today, I'll sell them throughout the day. So I'm getting cash flow coming in throughout the day. I don't necessarily return the money to the bank. I'm keeping it in my wallet and I'm recycling and buying other stock before I need to pay back.
Before you're even doing anything else with the money.
Exactly. So you find that. So there is something to be said about more cash flows, stronger cash flows. And this is a big shift bankers have struggled with even in our markets. It took them a long time to recognize that.
There's an informal system running.
Stop doing lazy banking where you're looking for collateral. Yeah. If, George wants a loan, you ask him, what land do you have? Yeah. You're not supposed to be lending against land. Yeah. Because all you end up doing is auctioning George's land. You become an auctioneer instead of a banker. You should
lend against your earnings capacity.
And exactly, your payback ability, your cash flows. Yeah. So it's taken a long time for banks to get that. The banks who got it have taken off like a bullet. Yeah. Equity Bank is a good example. NCBA Bank is another example. Yeah. Capitec in South Africa is another example. Yeah. They understood digital money, they understood mobile money, they understood cash flow lending, and they've overtaken the incumbent traditional banks. And these new banks are taking over.
Yeah. Yeah, the fintech investments as well.
Exactly.
Absolutely.
Exactly.
And if we go a little more into M&A, right? I think maybe we can distinguish between, growth M&A and PE buying versus SME M&A as well. Or is PE still a main buyer of SME businesses in Kenya?
PE is still the main buyer. And again, it goes back to what we said earlier when we were talking about the availability of financial products in the VC space. There's a lot less financial products.
Yeah.
So a lot of VC money is really for early stage startup type. There's not much for inorganic growth.
Yeah.
So picking up other assets. So a lot of the M&A comes from the PE side.
Okay.
But what you find PE doing is we're starting to see some consolidations. So PE getting into a merger. We're starting to see acquisitions. So big ones announced recently, Nedbank and from South Africa and NCBA. We've seen sometimes so a lot of them are the bigger PE type.
Yeah.
Some of them is corporate. Some of them is actual PE going in and acquiring and putting it on a platform, etc.
Yeah.
But in the VC space, less so. But it's definitely there. Now, what's missing again, even in the PE space, is you'll find straight out private equity funds that focus on growth, straight out private equity funds that focus on early stage, but you don't find many private equity funds that focus on buyouts in Africa. So you find them in Europe, you find them in North America, you find them in Asia. There's nobody who sets up a buyout fund in Africa. We don't have that many products. The industry is still very nascent, but it's the way to go. And why is that important? Because our businesses, as much as we're very proud of our local businesses and the sizes, they're very small. They're Mickey Mouse plays. That's the term I like to use. And that's why for us, even as AfricInvest, we always think about, can you consolidate? Can you have a regional asset?
Yeah.
Why regional? Helps you to de-risk. When you have naughty elections in one territory, at least you have stable businesses in the other five.
Elections.
And then before the other ones come back. And so, it's something that goes around because even Kenya will have its fair share of, nonsense.
Yeah.
But the beauty about regional plays is you de-risk your country.
Yeah.
You take care of your country risk.
Yeah.
But also it gives you scale.
Yeah.
Now, scale is important with regional assets. Scale means you can do M&A. Scale means you can talk to Chinese companies, you can talk to American companies, you can talk to European companies, you can talk to South African companies because they want scale.
Yeah.
And so
they want an opportunity.
Exactly. So M&A is important. But again, in all of that, we must always think about regulatory risk. That's a big deal. And it goes back to what you started to allude to.
You can't insure transactions here?
You can. It's better than it was before.
Okay.
You can actually get insurance today. For Africa. Before, again, because of the Africa risk, it was highly priced. It didn't make economic sense. Today, you can. And you get it from Lloyd's market, you get it offshore. So it's doable.
Okay.
But regulatory risk is a big risk in terms of, credits to regulators like in Kenya, where they allowed Safaricom to grow. In other markets, that would not have happened. The banks were making noise. Why is a telco coming into our space? But that's what innovation is about. Yeah. And that's what allowed, M-Pesa to happen, M-Shwari to happen, and all the others that have followed, all the grandchildren and the children that have come after that. There's been a lot of innovation, and that's contributed again to the Silicon Savannah. That's been one of the big drivers. The tech, the digital, the mobile money, that opened the doors. Now, if we had a very rigid regulator, that would not have happened. Yeah. So regulator is important. They have a role to play. They must make sure they protect public good, but they also must allow innovation. They must have sandbox models that allow you to test different models, that allow you to create jobs, that allow you to let people use their skills, whether it's on technology or mobile, et cetera, et cetera. So regulatory risk is important. And again, one must always keep your eye on the risks that come with that, whether it's related to cybersecurity, whether it's related, because that's a big one. That's a very big one.
What is how about if I'm an SME business owner I used to work in SME M&A, and we always had the talk where, they turn 50 or 60 and they've worked very hard all their life. And,
yes.
it's time to take a step back.
Yeah.
How does succession look like in Kenya? Is family succession still a very big thing?
Yeah.
Because in Europe they've let that go, and nobody wants to take over the family business anymore. So it goes to strategic buyers, PEs.
Yeah, it's an issue, especially if I look back. It is an issue. I was going to hone in on particular communities, because some communities are more entrepreneurial. Like if I look at the Asian community, business community, they've tended not to go for opportunities in the academia. They've tended not to go to work for companies, tended to start their own businesses. So they set up a lot of own businesses, whether it's in the manufacturing.
Themselves.
Exactly. But then what happens is you soon run into succession issues, because you run a successful business, you take your kids to all the best Ivy League schools, and then
they're like,
yeah. I've got one friend who said to me, Daddy, he said to me that my kid said to me, Daddy, you didn't take me to school to come back and be a dukawala. That in Swahili means, a shopkeeper. I'm not going to do that. So you find that the children do not aspire to work in those family businesses.
Yeah.
So suddenly, and actually I'm traveling this week to Kisumu to meet a group of very successful entrepreneurs to address exactly that.
Yeah.
They have a succession issue. They don't know who's going to take over.
Yeah.
So what must they do? They must professionalize their management. They must start to find a way to build in employee share options.
Yeah.
So they
Employee
can also
ownership,
exactly.
Yeah.
So they can start passing to the next generation, and next generation may not be their kids. Next generation may be management. Next generation may be a PE
or strategic buyer.
Yeah. So they have
Your
to start thinking
competitor.
that. So it is a real problem, absolutely. So very often when we invest, there's an issue around succession.
Yeah. What would be your advice to a founder to be able to build a scalable business in Nairobi in the next 10 years? Like a few things. Which sector should he focus on, or she?
Yeah.
Which school should you go to? Which incubator should you find? When do you call George?
Yeah. And please remind me to say something about a school in a short while, because I was going to.
I'll write it down.
You write it down, because I was going to say it earlier and I didn't when you asked me a question. So, but sectors which make sense. You can't go wrong with the financial sector. Everybody needs
Everyone is
money.
in fintech.
Yeah, you don't have to be a fintech.
Okay.
You don't have to be a fintech. You can be an insurtech.
Okay.
So you don't have, but you have to think about the financial sector. You can't ignore it.
Yeah, you have to include it in
And
everything you
even
do.
though financial deepening is done, basically the financial sector, banking per se, has done better in terms of financial deepening, the insurance sector has done miserably.
Okay.
If you look at the let me try and remember my numbers again, 2.5%, 3% is probably the penetration rate for insurance in Kenya. And
That means 2.5 to 3% of people have insurance?
that's what the numbers say.
Oh my.
Exactly. And how do they compute it? The computation is debatable, and it's subject to
We can
discussion.
have another episode about
Exactly, because it's done as a percentage of GDP.
Okay.
But it's a low penetration. If you compare
It's
to
low,
South
like even
Africa, it's
anything
double
under,
digits.
yeah.
If you compare, and South Africa is the best. So there's a lot more to be done there. So financial sector is still a good sector to
Financial
invest in.
inclusion as well. I
Financial
think, is a
inclusion,
big one.
actually, that's a better way to put it.
Yeah.
It's a bigger,
Anything
it's a
on the
big, more
financial-
broadly. You can't ignore energy. We don't have enough energy penetration. Cost of energy is very high here.
Yeah.
And so you've got
But
to
you
be
have so many natural resources.
so many natural resources. You've got it. You've got to be speaking about solar. You've got to be thinking about wind.
Yeah.
How do you commercialize these operations?
Yeah.
I was speaking to a guy. He'd kill me. I'm not even going to tell his business model, but he's thinking very innovatively around energy. But that's how you've got to be thinking. So energy is a big sector to be thinking about. And gone are the days when you sit back and wait for government to do everything. That's not going to happen.
Yeah.
One, they don't have the capacity. Two, so it's just energy is the next one. Another one that you have to think about, because we talked about the need to add value locally, you can't ignore manufacturing.
Manufacturing.
But manufacturing is changing also. You can't just be doing manufacturing and saying, I'll employ X number of people. You've got to be thinking manufacturing, but what's going to make you more competitive than China?
Yeah.
What's going to make
already
you more
coming
competitive?
into the country or leaving?
Exactly. So can you partner with the Chinese, who have a shortage of population, and can set up manufacturing plants in Africa here, rather than having to ship things from Guangzhou or from Beijing, bring them here? If they can manufacture here locally and supply the local content, is that the way you can be thinking? So manufacturing is a big one.
Yeah.
You can't ignore education, because, and it goes back to the school conversation, you can't ignore education, you can't ignore health. Why can't you ignore those? Traditionally,
Also access. Yeah.
exactly. In European countries, government does this.
Yeah.
In Africa, governments have other priorities. So it's
Yeah.
falling through the cracks. So how can you give access affordably in these areas?
Yeah.
So those are some of the sectors that are worth thinking about when you think about investment. I told you to, let me tell you
Yeah,
something about schools. Just as a closing, the thing is with schools, we don't today have curriculums around private equity in our
In
countries.
universities?
We don't.
But you don't have a corporate finance education?
We don't.
Huh?
So you can go and study BCom finance, you can go and study BCom insurance, you can go and study BCom banking. Those are all
But
traditional.
not corporate finance?
Nope.
Okay.
I've been called a few times to go be a guest lecturer in some of the top universities, Strathmore,
And you
USI,
said, I love the
USLA.
idea, but I have deals to run.
No,
here."
I do it. I do it. And I do it
Good.
for just because I want to add value.
Yeah,
I'm not
good.
getting a fee for it or anything. I do it.
Yeah.
I've been fortunate also being called to Columbia University in the US.
Nice.
But this I do because I can add value. But
Yeah.
we don't have this in our curriculum. And I've had this conversation with some policymakers and I said,
Yeah.
if we want to be competitive, that's what we need to be thinking about in terms of curriculum.
Yeah.
When talk about curriculum changes, these are the relevant things, courses which are coming up.
Yeah.
So,
Things people
otherwise
really
you
need.
always find that people who study abroad are at an advantage over people who have gone to school locally because they haven't got training in investment banking, haven't got training in corporate finance, haven't got training in private equity,
Yeah.
haven't got training in a lot of these courses which are being taught abroad,
Yeah.
which really should be taught locally today.
But also, I think that the course would be so different, right? Because if I think back
Yeah,
about
it'd
the
be
people that
powerful.
had the courses on whether it's real estate to corporate finance, half of what you've told me today doesn't happen in Europe that way.
There
right?
you go.
So,
So you get real case studies.
Yeah.
Somebody like James Mwangi, I mean, when I was doing my MBA, he came to speak to our MBA class. He blew the class away.
Everyone was
Just
so surprised, probably.
telling the story of Equity Bank. The number of case studies that have been written about Equity Bank, Harvard, Columbia, other universities. They're real rich case studies here. So it's no longer about General Electric,
No.
which was the good old days people studied back in the days. It's relevant new companies today.
Yeah.
The business has changed completely.
Yeah.
So that's something we could do to enrich and enhance our education. So if you're an entrepreneur looking to start a business, I'd be thinking about those sectors. You cannot ignore technology. Huh? That's the
Yeah,
other thing,
of course.
overriding technology. So, there are many, you can, again, talk about technology the whole day, but you have to be investing in that. You have to think about your structure. So you can't do it alone. Can you think about succession early?
Already,
Yeah,
yeah.
think about financing early.
Yeah.
And partner. Don't do it alone. That's what I'd advise.
work together. I
Yeah,
like that.
yeah.
So-
And there are associations. So if you think about the East Africa Venture Capital and Private Equity Association, there's the Africa
Yeah.
Venture Capital Private Equity Association.
There's ways to be exposed
Exactly.
to all the options
Yeah.
that
If
there
you're
are.
asking, do I need to find George? No, you don't need to find George. But you can go to the industry association and ask, who does VC? Who does
Yeah.
PE? Who does private credit?
Yeah.
Where can I get a good lawyer who understands this? Because it's not your lawyer who does your real estate who come and do this for you. It's a completely different skill set. So it's M&A, it's a VC
The whole
structuring.
ecosystem is represented there.
It's
You can find them.
represented there, exactly.
Yeah.
And the Africa Venture Capital and Private Equity Association has a conference coming up in Nairobi
Yeah.
in April, end of April, last week of 27th. We're expecting 800 to 1,000 investors who have an interest in Africa to be
really
in
good.
town.
Yeah.
And so that's a big conversation, but it tells you about the convening power. Talk about several billions of dollars
Yeah.
in the venture capital, private equity, etc.
And Nairobi as a hub.
Exactly. It just
Yeah.
tells you the importance of this part of the world. It's the hub into the region.
Perhaps about Nairobi. So one of the reasons, of course, I'm doing this podcast is because we talk a lot about clarity and narrative, right? The idea people might have of the city and the country versus what it really is. And unfortunately, we have to wrap up.
Yeah, no
So
problem.
my final question is then, can you describe what Nairobi or Kenya isn't in one word and then tell me what it is?
Kenya is the hub into the region. It is the hub gateway into most of Africa from a logistics perspective. Kenya is the place where you'll find a very strong, well-educated population. Kenya isn't some crazy country where there's no rule of law, where there's this perception that crime rules the day. We actually have the number of crimes you have in a month here cannot be compared. In a day here, in a month here cannot be compared to what you have in a day in a lot of parts of the world,
Yeah.
including some other countries in the continent that shall remain unnamed.
Felt so very safe here
Yeah,
so far.
yeah,
So,
yeah. But obviously Kenya's not perfect, has its weaknesses. We need to improve on governance like a lot of African countries, but we're way ahead of others.
Yeah. Thank you. Thanks for joining.
Most
Appreciate it.
welcome. I enjoy the conversation.